Leap of Fate podcast fans. Welcome to this week's episode with yours truly, as always, Randy Silver. Leap of Fate is around overcoming adversity, helping teach life lessons, helping you be the best version of yourself. And something that a lot of people reached out to me and asked me about doing a podcast episode, which is very relevant to everybody's daily life, is what's happening today in the stock market, investments, everything like that. We've seen 2022 has been very much of a down year after there was definitely a bubble created in 2021 via what was happening with the pandemic, stocks going up. So stocks have to go down at some point, and we're seeing the effect of that. People have been asking, why is that happening? Diving into it, what's the future look like? So I wanted to bring on an expert to be able to help us out. So today, my guest is James Woodall. James, say hi to the fans.
Hey, everybody.
James is the founder and CEO of Woodwall Wealth Management. James' passion for wealth management has always been around. Since a child, he was fascinated by the stock market. In junior achievement, has always been drawn into investing. He graduated from Texas Tech with a degree in international economics and finance after studying mechanical engineering and realizing it wasn't for him. Both very smart subjects, so you can tell he's a very intelligent human being. Moving into the finance industry, he fell in love with wealth management and worked with advisors for a decade when he realized his passion for financial planning, becoming an advisor himself. So today he's earned his certified financial planner certification from the CFP board using the SMU's program. And he's able here to come talk to us today about the stock market, everything's happening, and how we can help protect ourselves and what could be some future things that we need to look out for. So this is hopefully for you to be successful and understanding how everything may be tied to you, tied to your family, tied to anything you may own, and how you can help protect yourself or what is needed to be successful moving forward. With that being said, let's bring James back into the podcast. James, welcome.
Hey, thank you for having me.
My pleasure. Before I dive into it, anything you feel like I missed that's important for the audience to know about?
No, you've been great. The research you do is pretty impressive and thorough.
Awesome. And if you're watching on YouTube, you can see that we have a nice little interesting background today. It's the stock market. If you're listening, of course, you only get to hear us. Please go to the YouTube channel at Leap of Fate. You can watch us do this. Of course, if you prefer the audio version, that's how you got it on all your streaming channels. So, James, I think a good overview just to say is stock market. Our audience here is very intelligent. I think we need to describe what the stock market is so we can dive right into it. Why are the stocks going down 2022 and why are we seeing all this pressure? What's happening with inflation? So I think a good place to start is let's lay the land of where we're at today.
Yeah, so definitely an interesting year. No doubt about that. We actually hit a bear market about a few weeks ago, which is a 20% drop in the market. When people say the market, they typically talk about the S&P 500. That's an index that tracks the largest 500 US companies. And that went from a 20% drop down to maybe 20.5 or so this year. And it's always kind of scary. It's a scary, very common thing, unfortunately, that happens where the market has cycles. It goes up, like you said earlier, and has to also go down as well. The reason why it went down for the most part is just we had historically low levels of interest rates down to zero. That made money very easy to flow around. When it was easy to flow around, it made it easy to invest in the future. So those growth stocks that went up dramatically, Apple, Microsoft, Nvidia, had cheap money to put down for forward future processes and revenues. So at that point, when the Fed said, okay, inflation's getting too high, which we can certainly talk about as well, and the factors of that, they said, okay, we got to tighten inflation. So how do we tighten inflation? Well, the only thing that they can really do is raise those interest rates from a historic low from zero now up to, I think we're going to flirt with 0.75 to 1% by the end of the year. That's what's causing this market correction, is that the market is pricing in those future federal increases. What we've seen in the past week, the stock market went up, I think the S&P 500 went up 6% because the Fed said we're probably not going to go up more than 1% for this year. So that's why we're seeing those changes in the market move, or one of the main factors.
If someone doesn't know, when their interest rate is rising, what's that interest rate actually put on? Is it put on the housing market, put on the stock market, buying stocks? Where's that actual 0.75 to 1% going to?
It's going everywhere. So that goes from the banks saying that the banks have to have less cash on hand to then spend more money, make it easier to loan out money. So a good example is mortgages, right? I think 6 months ago, mortgages, if you had great credit, 30-year, you're probably flirting with 3%. Well, now mortgages, because mortgage companies are expecting that increase, they're already saying 5.5%. Same thing with auto loans. Basically, what it comes down to, at any point you need to borrow money, it's just becoming more expensive to borrow money from folks like you and myself, as well as companies.
Got it. And so then how does inflation play in part of that? Is one of it caused by what you're seeing in the market or in the news? There's less products out there. Is it caused by all the stimulus money that came in because of the pandemic? So now there's more money out there. What were some of the root causes of inflation, and what made it kind of come out of control starting in 2022?
The answer is yes. So it's kind of all of that. And so, personally, my opinion of putting a lot of money into the market was the right move by Jerome Powell. I think that was the right thing to do at that time because we had a sector, especially the services sector, that was just shut down. So I think that was the right move to do. Now, thinking about that, we know this is going to happen. So you put a bunch of free money out there, and then now because it became so much more easy to get assets, you could say, or buy things, we started having prices creep up because more people had more money to spend. And therefore, those prices crept up because it's the nature of the market. At that point, we also ran into another issue, a compounding issue, which was that supply chain crunch. So think of automobiles as a perfect example. So they became less available, but people had so much more money, it raised that price up. People are still willing to pay, so people are still willing to sell. That's what we're kind of running into, is a simple supply demand issue. And then on top of that as well, we're running into an energy crisis. We had 2019, we had a oil refinery or a gas refinery burned down. We didn't replace that supply pumping in that gas. Meanwhile, we still have that demand coming in. And that's actually been a dramatic increase in the reason why we're facing so much inflation, simply because of those supplies that are out there, they're harder to get or more expensive to get to the store shelves. And because people have more money to spend, they're going to spend that money. So it's kind of a cascading effect. So that's why we're raising interest rate to really throttle back that spending and lower that inflation.
One of the questions that pops up, and maybe you don't know this because you're not part of the US government, fair enough, is like, you always hear we have all these reserves, oil reserves, things like that. I know Biden at one point released oil reserve to try to help it, but if we have all this oil, why are we so dependent on trying to continue to buy it versus using the stockpile that we have?
That's $1 trillion question right there. I mean, I grew up in Texas, right? I grew up in the oil field. I went to school in West Texas. It's a frustrating thing. I think it may be more of a policy decision on more of a practicality decision at this point.
Got it. I'm sure a lot of people have that question, so I just wanted to make sure. So again, like I said, preface it, you're not part of the government. But then I would say a second question is, obviously, unfortunately, the global events of what's happening between Russia and Ukraine. How is that playing effect in what we're seeing hitting us home in terms of stocks and or prices for goods and services?
Yeah, so that's an interesting one. So the more I've been digging into it, is one of the main things we did was we took liquidity out of the system. We made it hard to move money in and out for Russia. So that's a big part of it. Another part of it is simply fear. I mean, that is a major nuclear power. We don't know really what's going to happen if they go to nuclear war or not. So a lot of people said, okay, we were making all this great money a few years ago. Let's start realizing those gains and selling it. When that happens, if you think of the major players like those ETFs, those mutual funds, those companies, it kind of creates a cascading effect because you're not as diversified as you think you are. And that just happens because if you hold, let's say, 10 mutual funds, they hold separate investments, they may hold a lot of the same things. So that happens across, 300 million people. It kind of adds up. Also on top of that, the thing that I think that has not come up as much lately is Russia, I believe, is the world's largest fertilizer producer. So folks around the world are having lower yields in their crops. Again, supply and demand, right? Yep. So they're having lower yields in their crops. Well, that's kind of hurting everybody. So they're having to innovate, joys of capitalism. So they're having to innovate, come up with new things. Meanwhile, we're having less supply. in that crop yield, as well as Ukraine, I think is something like a 30% producer of wheat or something
Yeah, I saw that
crazy
as
like
well.
that. Yeah, so I think that's kind of compounding as well. So I don't think we're out of the woods yet, but we'll get there. We always do. We'll find a way
Got it.
and see where it
And
goes.
then a follow-up question then is, okay, stock market's not going well. You know what? Crypto market's out there. Let me diversify my assets, put in the crypto. However, we're seeing the crypto market has taken the same type of downturn. And also, if you're a big crypto follower, Terra, which was a very popular one, went from a couple cents, maybe even the dollars, to zero. And investors lost all their money. So why are we seeing a downturn in the crypto market as well if A, they're not tied together, or B, when we've had crypto people come on this podcast before, we're learning there's more institutional investments in the crypto now. So they are tied together. Why that's actually not a good way to diversify yourself right now if the stock market's not doing correct.
Yeah, I'll probably make them mad. I'm not a big believer in crypto, and I say that I used to hold 30 shares of 30 Bitcoin, I guess, way back in the day. It was like $1 each, and I gave it to a friend for a case of beer.
You probably kicked that one a little bit.
Yeah, I was
Most
pretty
expensive
wrong on
beer
that.
ever.
Oh yeah, those Keystone, of course.
Yeah.
So I honestly I don't know. Crypto is such a new, fascinating area. I think it's interesting, but would I invest in it personally? No, I personally don't. Um, I don't know if this is honestly shooting from the hip. I'll be honest with you. If there is the oligarchs at play that lost that liquidity from their normal assets, are
Hmm.
they using that to move it around, sold it? I don't know. I honestly
Hmm.
have no idea.
Fair.
I'd be kind of curious to
No,
see what your experts say, because I honestly don't know. I'd like to
yeah.
learn.
So I would say we're an episode in the mid 90s. It was like mid 70s. I had a crypto expert come in. He runs a crypto firm, and he
Mhm.
talked about that there's so much institutional money from banks and high level investors in crypto market now. So they were using it as when the stock markets went up, they were then taking profits, putting the crypto. Crypto would go up because people were seeing it go up, so they're taking those profits back and forth. Now that there's no profits to be taken altogether, people are just taking the money and keeping cash. They're taking it from both of them, which is driving it down. So it's creating a run sell across both markets of people following suit, trying to get realized earnings before they lose them all.
That makes sense. It's almost like a bank run.
Yeah, exactly. Exactly.
Huh. Interesting. Okay, it's good to know.
Yeah. And
Learn
so
something new every day.
he said the same thing about his Bitcoin. He shot himself in the first. He still has some, but he sold his for natty ice.
I
That's a joke.
don't know if it's better or not.
Yeah. So then for yourself, James, and over at Woodwall Wealth Management, when you have clients come to you saying, hey, this is happening, what's some advice? Maybe obviously each situation is unique, but how do you go about helping people understand what's happening to their unique situation and what to look for in the future?
Yeah, absolutely. So times like these are really when an advisor is worth their weight in gold. The reason why is that we're really helping you to stop from making a mistake. So a good example is selling out of the market. If last week you said I can't take it anymore, I'm going to sell out of my investments and go to cash. I can't stop seeing it lose. Generally speaking, at that point, it may go up. There's even a theory on it called the odd lot theory, where smaller individual investors do the opposite of what they do. Um, so typically what I say with folks is let's go back to our fundamentals and see where we're at. Are we in investments that are matching our risk tolerance? The folks that say they want to be aggressive today and they say, oh, I can handle a 30 or 40% loss. Well, you're being tested right now, honestly. And if you can't, that's okay. If you're younger, it's a great time to say, okay, do I need to ride it out and focus on the long term? Or do I say, this is not who I am. I can't handle the risk. And we dial back the risk tolerance. So typically more cash and bonds compared to just stocks in your account. And we throttle it back a little bit. So that's a big thing to do. Another thing also, it's a great opportunity to do Roth conversions. Because when
Mm.
we think about it over a lifetime, we typically think, oh, I made 1,000% on this investment. Well, you still got to pay taxes over time, right? So a good example is, let's say you bought, I don't know, I'm going to use a fake company. I'll say Apple at
Okay.
$100 a share, and Apple went down to $50 a share because of this bear market. It took a beating. Well, you still own that one share or 100 or 1,000 shares. So why not move it from a pre-tax account, your retirement account, to a Roth IRA or a Roth 401k if you can. And yeah, you pay a little bit more taxes now, but now you have tax-free growth the rest of your life. And on top of that, you also have to do RMD, so no required minimum distributions at 72, because your tax rate actually increases in retirement, and no one really talks about that. So you may make an overall better return just by being smart about moving money to after-tax accounts when it's at a discount.
And that's obviously the benefit of having a wealth advisor and working under them. For the average, say, retail investor who's using a Robinhood, a Schwab, like just an app on their phone, and they don't have that type of capability, am I able to then, using Robinhood, change it to a Roth? Or is that something where I'd have to take the money out and then take it to a firm that would allow me to make that happen?
Yeah, you can do it at Robinhood. I know when I worked over at Fidelity, it was very straightforward. It was literally sell the assets in account A. We're going to move the cash over, buy the same thing in account B, in that Roth account, and you can open it. So you can do that, I believe, at Robinhood. I'm sure at all the major discount brokerage firms, you can do it very simply.
Awesome. And if you have any questions, I'm sure go to their website of the discount brokerage firm using, or just type in YouTube, how do I do it? And I'm sure someone has created a video for you to show.
Yes, they're definitely out there.
And I would say, based on the first part you talked about, like, what's your risk tolerance? Fair enough. I probably have lost 6 figures in the stock market this year. I bought in before pre-pandemic, shot up, unrealized gains. Now they're back down to where they were. So did I ever tangibly have that money? Probably not. Fair enough, because I never pulled out. Am I okay with it? Yes. I just choose not to look at my app every day, knowing that my end game is a 20, 30-year gain. If I ever want to buy a house, the money is for that. If I want to, have a nice vacation, et cetera, et cetera. I'm not here to try to make money nickel and dime my way up and be a day-to-day investor. It's the long-term game for me. So do I like seeing it happening? No. Do I like seeing that red? No, but I just choose to know what my goal is, and I don't let it affect my day-to-day, which is something that you were talking about.
Absolutely. There's a good trick you can kind of play on yourself too. What sounds worse to you, Randy? Does it sound worse taking a 20% pay cut or living off of 80% of your income?
Oh, that's a tough question. I would say living off of 80% of your income.
The joke is it's actually the same. So if you think about it, right?
Yeah.
So it's a totally normal, totally rational human behavior that losses hurt more. So if you can ride it out, you're planning long term, you're set. Another thing too is having emergency savings, 3 to 6 months of cash for your necessary expenses, but also a little bit of fun as well for people.
Yeah,
that will help you get through these moments too, and it'll help you grow so much more in the future.
Got it. And what would you say to people? Definitely saw a lot of retail investors going for the first time around the pandemic time. Hey, I'm at home, extra money, not going out. Stock market's going up and up. Oh my God, great. Now they're actually really feeling the up and down motion of the stock market the first time. What is some feedback or advice for those people? If it's the same thing, then, fair enough. It's the same advice you just talked about.
It's natural. It's perfectly natural human instinct to want to see losses. Me personally, I always hate seeing red in the account. You want to see green, right? But just remember the number one rule is faith in the future. There's something that, this is the American economy. This is a uniquely American thing. That American spirit has been around throughout history. When we first started as a country, I believe we were trying to grow, I can't remember what it was, but ultimately started growing tobacco. When, oh, wow, this is actually really good. And so our entire country is founded on that spirit. And if you look at our tax laws, if you look at the market, how we invest, how everything is designed to do is to continue to grow and to adapt. So think about it like this. We're driving towards a cliff. It's not like we're going to turn the steering wheel, or like we're not going to turn the steering wheel. So always just keep that in mind. It will get better. It just depends on when. And truth of the matter is no one really knows.
And that's a good segue to the back half of the conversation we have here. Is I'm going to change my interactive screen. Is we have arrows, if you're not watching on YouTube, up and to the right. So we were talking off podcast before we started that you were saying, stocks eventually always do grow. Can you just kind of talk about historically what we've seen in some of the ups and downs, the recession 2018, Obviously, we had the Great Depression, 1920s, which if you're listening to this and you're still alive, thank you for still listening to the podcast at this point. But can you kind of talk about what people could expect to potentially how long something like this happens and how often maybe the ups and downs happen, if you have any knowledge around it?
Yeah, so the average, let's say average recession, happens, or average bear market recession averages about once every, I think it's 20% of the time. So it's like 2 years out of 10. That's kind of the average. Um, what happens is because we are in a cycles of a market, you have a early, mid, late recession. If you think about that, we're kind of flirting with a late to mid area, probably in that later cycle. Well, you don't always have to go in a circle. You can always go back to a mid depending on what happens, but it's consistently what we've seen over time is the market after hitting a bear market does grow up dramatically for whatever reason. Policy changes. People have said, okay, I have enough cash on hand, I can invest, and more people put money into the market. It typically goes up pretty well afterwards. I think only after one bear market, it did not go up double digits within 5 years. So it always, you got to write it out. That's why we always say, the fundamentals of financial planning, right? Have that emergency savings, protect your income, pay off credit card debt, and then really start investing for that long term. And it will work. It always comes back. It never has.
Awesome. That's really good advice. And what I loved you keep saying is like making sure you have the savings. Like don't go out and start spending a bunch of money, putting credit card debt, making sure, if you can't buy that pair of shoes today, probably smart not to buy those pair of shoes. Make sure you can take care of what's a necessity first, which is roof over your head, food, personal things that may be needed for your own livelihood. I love that.
Absolutely.
So, James, a couple more questions for you. You've been so generous with your time, and we'll let you go enjoy your Friday afternoon when we're recording. So, you mentioned that like we have these ebbs and flows, and people don't really know what's happening. Just from your own research and what you're hearing in the news, how long do people think this current bear market and current economic climate may potentially last?
I'll be honest with you, I'm not sure. Personally, I think it's going to be, I've been using the word choppy, which means I'm not really sure what we're going to run into. I don't know when we will get out of it. Will it be 10 years? Doubt it. Will it be a short-term issue? That's what I'm hoping. That's what we're planning for. We're going to have to wait and see. I think a lot of it's going to be a pretty interesting summer as we still have high demand for energy, for gas, as well as that Russia and Ukraine war. So I think those are major headwinds. Once those kind of get alleviated, I think we'll definitely turn that cycle or turn that corner.
Are there any tall tale signs that people can look for, say, in any type of economic reports coming out, anything that, say, the president, government's doing that'd be like, okay, this is a sign that we're on the recovery, or this is a sign that, maybe I really should look at pulling my own money out to make sure I have those reserves for myself if it's going to get worse?
Yeah, so there's definitely a few key economic indicators you can always look at. One of the ones I always look at is durable goods orders. So those are typically your big, heavy machinery that you're investing in your company for the long term. When you see that increase, you're typically going to see a positive signal in the market because people say, okay, we know the future is going to get better. It's time to start getting ready for that. That's always a pretty common one to look at. Another one is going to be the unemployment rate. Currently, we're at historical lows in the unemployment rates. So as unemployment goes down, spending goes up. That's always a great thing to keep in mind as well. In regards to the market and the Federal Reserve, it's kind of hit or miss. We want to sit around, the goal is typically a 2% rate at the Federal Reserve. That seems to be where they want to target for a healthy economy. So if we get there, hey, we're doing good. It just takes time.
Knock on wood, wherever you may be having wood. Two more questions for you, and then I'll let you go. So this is being recorded in end of May of 2022. In November 2022 in the US, we do have midterm elections. So it's an off-cycle election year, meaning it's not a president election, but there are senators, obviously the House representatives up, governor, House races, everything like that. How might that play an effect in the stock market and what people may be doing for looking to it day of, or once the dust settles into the results, how that may play effect in the next year, which is 2023?
Interestingly enough, the market does not care about who's in office.
That's good.
It's a good thing. The market generally cares about certainty. What are we going to see in the future? Because if I'm owning stocks, I want to see a company grow for whatever time in the future. Um, that'll be pretty interesting to see what happens. I honestly don't know. Typically, you can always pull up the data. More or less, the market doesn't care, which is a good thing.
Yeah.
Yep.
Last question for you, then we'll let you go. Is there anything else of noteworthy just for the audience that may have not asked the question that you think is important for them to be aware of, or something for them to know about you, anything of that nature?
Yeah, I think probably the most important thing from talking to family and friends is the cost of timing the market. So a good example I always use is if you put in $10,000 in the S&P 500, so the 500 largest stocks in the US on January 1st, 1980, and if you stay invested the entire time, that number would flirt with $697,000 as of March, I believe 2020, right when the market went down. If you try to time the market and you miss the best 5 days, that number goes from almost $700,000 to $450,000. If you miss
That's a
the best,
huge range.
oh, it gets even crazier. If you miss the best 50 days in the market, that $10,000 from 45 years ago or 42 years ago goes down to $48,000 just by
Holy
trying to time the
smokes.
market. Yeah, if you miss the best 50 days. So stay invested. It truly does work out in the long term. I know it can be a rough ride. In the worst case scenario, just always invest in quality stocks, funds, ETFs, etc. And it works.
As a quick follow-up to that, there's that saying, it's a time in the market, not time in the market. It kind of seems like maybe vice versa. It actually is time in the market to make sure if you're trying to pull out, you're pulling out the right time. So what would just be your rebuttal response to that?
Yes, huge fan of that. So there's a few ways to deal with that. So when you're pulling money out of the market, so for example, my parents are about to retire. There's a lot of tools out there besides just a mutual fund or a stock or crypto or an ETF. There's also annuities. They have a bad rep because they were typically sold to people that need them. That's definitely changed the market. Candidly, I use annuities for that situation where I have a steady income pay because we know what people are going to be roughly spending. You have your average budget of what you're going to be spending. Okay, great. Well, I'm going to have an annuity that's going to pay out a consistent income for that. That way, I don't really care about the market going up and down. And we use annuities and not bonds because, again, the rates are so low now. As rates go up, bond prices go down. And so that's why we kind of leverage those.
Got it. Great. That's super information. Everybody,
Yeah.
I hope you've enjoyed today. James has done an amazing job at helping us understand the stock market, correlations into what you're seeing in macro and micro issues around the world, understanding potential historical data that helps you feel comfortable with what's happening today and what it could be like moving forward and how you can prepare yourself. And of course, always make sure you have that safety fund for yourself 3 to 6 months because that's most important there. James, any last words?
I really do appreciate the time. It's been great. I hope this helps everybody, and feel free to reach out.
If people want to reach out to you, if they have any questions, want to find your firm, how can they reach out to you? And everything that he says, of course, will be in the bio of however you're listening or watching.
Yeah, the best way, honestly, is to go to my website and schedule time. It's a pretty long name. It's woodallwealthmanagement.com, WOODALL.
Perfect. And again, that will all be in the bio of how you click. Thank you so much. Hopefully, when you're watching this and whenever this is, it's up and up to the right on the green day. So fingers crossed there. Thank you so much for joining us this week. I would like you to do the sign off with me. So please repeat after me. Stay healthy.
Stay healthy.
Stay wealthy.
Stay wealthy.
And have a good week, fans.
And have a good week, fans.
Deuces.
Deuces.